is, and as I had said a couple of times, we're going to do chapter 6 and then chapter 5. So let me go ahead and put it into slideshow mode. Okay, and what we're going to do with chapter 6 now is start to dig a little bit more into the internal control. So as I was just saying, as we were reviewing the midterm, and I'm going to, unfortunately, I wish I knew how to make my marking show when I'm in slideshow mode, but I think this is okay. Okay, as we reviewed when we were looking at the midterm, we have our audit risk. Audit risk is comprised of our risk and material misstatement times our detection risk. But our risk and material misstatement has two components to it, our inherent risk and our control risk. Now we've talked a little bit about inherent risk. Inherent risk is the risk associated with an account balance and the assertion associated with that balance, assuming there's no controls. Cash, diamonds having a high inherent risk, fixed assets, a lower inherent risk. And then we look to our control risk then, or our controls to mitigate that risk. If our control risk is high at the maximum, then to keep our audit risk low, you always want your audit risk to be low, then we would have to keep our detection risk low. And I had a question about the numbers here, guys. The numbers are not, I'm never going to give you a question that has, you have to numerically figure this thing out. It's just to give you a sense that in order to keep your inherent risk, your audit risk low, you would have to keep your detection risk low, say at a low level, just using a number, an example, 0.05. And so the way we would do that is we would increase our substantive testing, increasing meaning nature, extent, timing, nature, using external evidence, extent, larger sample sizes, timing, using year-end testing instead of interim testing. If we were in a situation where our controls were a little better, our control risk is at moderate, now we can accept, and never say a high detection risk, we can accept a higher detection risk, meaning our substantive procedures can come down, nature, extent, timing, nature, using now internal evidence instead of external, extent, smaller sizes, timing, doing interim testing. So just repeating what we said as we were reviewing the midterm. So what we're going to do at this point then is say, well, if that's the case, okay, how do I assess this control risk? What elements should I look at? Is there an organized way that I can look at the controls in order to make this assessment of the control risk leading to my risk and material misstatement? And so then I can go ahead and determine the timing, extent, and nature of my substantive procedures. Okay, now just to look a little bit ahead, we're going to see that for a non-public group, I look for assessments of my risk, specifically with the goal of determining the nature, extent, and timing of my substantive procedures. We're going to see that I don't have to test the operating effectiveness of those controls if I have assessed the risk of material misstatement to be at the maximum, or if I've determined it would be more efficient to skip my testing of the operating effectiveness of controls and move directly to substantive testing. That's the case for a non-public company. For a public company, I would do the same thing, make the same assessments. I would test the operating effectiveness if I believe the controls had operating effectiveness. In other words, the risk, the control risk was less than the maximum. I would, if I believe the control risk was at the maximum, I wouldn't have to test the controls. If I believe the control risk was less than the maximum, then I would have to test those controls, because that would lead to my opinion on the internal control that's required under PCAOB, Sarbanes-Oxley requirements in section 404 of Sarbanes-Oxley. Okay, so just a little bit of look ahead. Okay, now when we look at internal control, we look at those internal controls in terms of their effectiveness in preventing or detecting a material misstatement in the financial statements. That's why we're looking at the internal controls. Okay, and when we look at the controls of an entity, we could look at controls relating to operations, those relating to compliance with laws and regulations, but those also related to the reliability of financial reporting. And I circle that, I'm going to star that, because as auditors of the financial statements, those are really the controls that we're interested in, those that deal with the reliability of financial reporting. We could look at the controls over the other areas, but our main focus is those that are going to allow the entity to prepare their financial statements and have the information there be reliable. In other words, controls that are going to prevent or detect a misstatement in financial reporting. When we look at the responsibility for internal control, management is the one that is responsible for the internal controls, okay, and making sure that those internal controls provide reasonable assurance the financial statements will be prepared without there being a material misstatement, okay. Auditor's responsibility, and again, for public companies, okay, that's for public companies, the auditor will need to do those same steps that we talked about: obtain an understanding of the control, evaluate the design, see that the controls have been implemented, make an assessment of risk and material misstatement. If the assessment of risk and material misstatement is the maximum, go straight to substantive testing. If the auditor believes that the risk and material misstatement is less than the maximum for public companies, the auditors must test the operating effectiveness of internal control, because that'll provide the evidence for the report on internal control. And we're going to look at that towards the end of the class when we really start to dig into our reports, both our report on the financial statements and our report on internal control. But for a public company, when you pick up their annual report, you see two reports from the auditor. You see a report on the financial statements, the opinion on the financial statements. You see a report and opinion on the internal control, okay? Now for a non-public company, auditor has the same responsibility: obtain an understanding of the internal controls sufficient to evaluate the design, see if the control has been implemented, make an assessment of risk and material misstatement, and then if the auditor wants to, feel it would be efficient, to test the operating effectiveness of control to get a lower control risk, lower risk of material misstatement, then they would have to test the operating effectiveness of those controls. The auditor assess the risk of material misstatement, the control risk at maximum, bypass the testing of the operating effectiveness, go straight to substantive testing. And unlike what we have with public companies, for a non-public company, the auditor may want to just bypass testing of the operating effectiveness controls, even if they believe they could achieve a lower risk of material misstatement, and move directly to substantive testing if they believe it was more efficient to do so, although we had said in an earlier lecture that's highly unlikely that would be the case. Okay. All right, stop me if there's a question, guys. Now, the structure that we're going to use, to be able to take a look at the internal controls, something that was prepared by the Committee of Sponsoring Organizations of the Treadway Commission. So I don't know, I think it was probably like the early 90s, they assembled this entity called the Treadway Commission. Treadway was the chair of the Treadway Committee, and they talked about a way of looking at internal controls that really is kind of groundbreaking, became the way that pretty much everybody looks at internal controls now. So you probably heard the term COSO. We talk about the COSO guidance, although the AICPA and other organizations also have a structure, but probably the most widely accepted is this COSO approach. Okay, so you can see that we have our objectives of our company going across the top, like we talked about operations compliance. But what Treadway did is they said, well, look, the most central one is the objective of reliability and financial reporting. So what they said is, well, we can look across the entity, okay? We can have entity level, we can dig down to operating units, functions, and then we can look at the element control, as you see here: control environment, risk assessment, control activities, information and communication, and monitoring activities. Now, I'm going to give you a mnemonic for remembering the elements, okay, of the internal control. And the mnemonic is crime, which is the control environment, risk assessment, information communication, okay, this one here, monitoring, this one here, and then you could think of this as existing control activities. And that E is in there just to spell crime. Now, the problem that I have with crime as a mnemonic is it doesn't help you to remember them in the correct order, okay? Because the order here does matter, okay? So if you look at this next slide, you can see that we've sort of given a priority and importance and a flow to the process here. I've also seen it depicted in the circular graphic as well, okay, but circular is not as good because control environment does sit at the top. Control environment is the most pervasive part of the control system in that it touches all the other parts. It includes involvement of board of directors. It includes making sure that the entities, employees understand their responsibility in internal control. So control environment, it involves human resources, hiring people that embody the values of the company, that sort of thing. So it sits at a high level and it touches the other areas, okay? Now, risk assessment, we'll get more into this, but I want to just make sure we're understanding that when we talk about risk assessment here, we're not talking about the auditor's risk assessment. We're talking about management's risk assessment. How good is management at looking at things that could affect their ability to achieve the objective of reliability and financial reporting, and then developing the next piece, control procedures that will help mitigate those risks, okay? What sort of safeguards will they put in place to mitigate those risks that they have identified? So if they are in an area that has emerging technology, let's say, what sort of control procedures do they put in place to make sure that their financial reporting process is keeping up with those technological changes? Okay, so the auditor is sitting here saying, okay, management, how good are you at looking out to the world, essentially, your business environment, and seeing to what extent those different risks could affect your ability to achieve the objective reliability and financial reporting? And then are you putting the control procedures in place to help ensure that you do get that reliability and financial reporting? So we come up with control procedures, but then we have to set up our information system so that those controls are actually working within that information system, and we have to communicate to our staff what their responsibilities are in the control, right? Because some controls are manual controls, and so each individual needs to understand their responsibility. So we have to have controls in our information system. We also have to communicate to our staff what their responsibilities are. And then what do? We monitor all that, okay? That's why this monitoring is sort of going across the whole thing. We monitor all that, and primarily we will monitor that through an internal audit function. So we may have an internal audit department that reports directly to the board of directors, or if our entity is too small to have an internal audit function, then individuals on the board of directors will have to add to their responsibility doing an internal audit function, essentially a function that sees that this whole system is working to achieve the objective, again, of reliability in financial reporting, okay? So again, these are the components. You look at them, and when we look at them, we're going to see that there are principles under each one of these areas, okay? So there are 17 principles in total, and you can see there are 5 components. So 5 components, which you've seen, are control environment, risk assessment, control activities, information, monitoring, and then within that we have principles for a total of 17 principles, okay? So when we look at the control environment, as I said, it sets a tone at the top. You saw on that earlier slide, it kind of is pervasive over all the other components, okay? It includes making sure that the board of directors is going to be involved in the control environment. And of course, the auditor will obtain an understanding, frankly, of all the elements of the internal control, all the components that we've talked about here, including the control environment. Remember, when we're looking at controls, remember we said obtain an understanding sufficient to evaluate the design of controls and see that the controls have been implemented. Well, that all includes understanding that control environment. Okay, you can see the 5 principles here. Okay, and probably the most important one here is board of directors. Okay, board of directors being the key element. We do expect that the board of directors and senior management, okay, will want to make sure that there's the appropriate structures, etc., board oversight, reporting lines. Remember, we said internal auditors should report directly to the board of directors, etc. Okay, so these are the principles that would come in under the control environment. Okay, again, the board of directors, there should be an audit committee that will oversee the audit. Okay, I don't know what 3 to 6 members, it really depends on the company. Okay, but it really is there to make sure that there's somebody that is financially literate, and there needs to be one financial expert. So don't be surprised after you get your degree from Golden Gate, you go and maybe get your CPA, you're working as an auditor, you work your way up to a CEO, CFO somewhere. Somebody will probably tap you to be on the audit committee of some board of directors somewhere. In fact, I have heard of, I guess you'd call them board of director fairs, where you can literally go to, you know, these different, like a job fair, but it's a job fair for boards of directors. And you get to go and talk to different individuals and make contacts and end up on a board of directors somewhere at some point in time. Okay, audit committee duties. Okay, oversight of the internal audit function is probably one that I'm, as an auditor, we're going to be very interested in, to see that that board of directors is involved, but also oversight of the external audit. Okay, so the audit committee is going to be hiring and firing the auditors. Okay, also approval of non-audit services. So if there's something, a service that's being provided, say not only are you auditing the financial statements, but you're also preparing the tax return of a public company. This is for public companies. Okay, what would happen here is under Sarbanes, there's a requirement that the audit committee approve those services, even though it may be a no-brainer. If you're going to provide non-audit services to an audit client, the board of directors does have to approve that. That's a requirement for public companies, and it would be advisable to be doing that with a non-public company as well. Okay. Okay, that's our control environment. Again, a lot about the board of directors there, right? Because they sit at the top of the organization. Stop me if there's a question, guys. I know some of this stuff, how can I put it? I understand that some of this stuff is not going to be riveting. Okay, so I'm going to kind of roll through it here. But so I'm going kind of fast, but if there's a question, just ask me. Okay, risk assessment. Okay, this is again the entity's ability to identify risks that will allow the company to achieve the objective of reliability financial reporting. Okay, that is not the same as the auditor's risk of material misstatement. Okay, 2 different things. Auditor assesses the risk of material misstatement, but they're looking, as auditors, we're understanding how effective management is at their responsibility to identify risks that could affect their ability to achieve the objective of reliability and financial reporting, and responding to that. What they could use, COSO also has an enterprise risk management framework that you may have looked at in some other classes. And that enterprise risk management framework is similar to the internal control risk framework that we looked at. And that could be used to help to assess these risks of achieving the objective reliability in financial reporting, but the auditor is looking at that risk assessment. Okay, so you take a look, and again, there are principles that go along with each of the 5 components, and you can see some of these, which is the ability to assess risk relating to objectives. Again, our primary objective here that we're interested in is the risk of reliability in financial reporting. So looking at how there could be a potential fraud that could affect those risks as well. Remember, we're looking and we're seeing to what extent the financial statements have a material statement, whether caused by error or fraud. So as part of that risk assessment, we would expect the entity to be looking at that potential as well, not just risk from error, but also the risk of the statement coming from fraud. Okay, control activities. These are the ways that we mitigate the risks once you identify them. So management, when I say we, now the audit client should be doing this, they should be looking at those risks and then seeing how they can mitigate those risks. Okay, for example, physical controls over assets. We used that a little bit in our example relating to the jewelry shop, right? We said that we should be having the items locked up in a safe with dual combination, separation of duties. Okay, there's a separation between the authorization of a transaction. Okay, let me write that. Separation of duties. Let's talk about that. Let's riff off on that a little bit. Okay, separation of duties. There should be a separation between the authorization of a transaction, the recording of a transaction, and then the custody of the asset. Authorization, record keeping, custody, ARC. Okay, there should be a separation between those 3: the authorization of a transaction, the recording of a transaction, and the custody of the related assets associated with them. So what happens? If I authorize a transaction, I should not be able to also record that transaction in the financial statements. If I'm recording transaction, I should be able to authorize it. And I also shouldn't have the custody of the assets. So you don't want the same person to be able to authorize a cash disbursement, not report the cash disbursement. The recording function, they would just say, hey, I'm not going to record that cash disbursement, and then have the custody of the cash or the checkbook. They can actually write themselves a check. Now they've authorized the transaction. They have custody of the checkbook, so they write themselves a check. They probably would never record that at all in the financial reports because they're basically stealing the money. You separate that. Hey, cash can't disperse until it's authorized. If the cash is dispersed, it's dispersed by a separate individual. And then when that's recorded, there's a third individual that would record that. Now, sometimes you say, well, what if the entity isn't big enough for that? Well, then there would need to be other reviews in place that would verify that, the same person that maybe records a transaction and authorizes it. You might have different ways of combining those or having another party look over the custody, or there'd be a second level review. So you can't always have these separated, but in larger companies, there would be an expectation, yes, that these 3 functions be separated. Now, this becomes important as we start to look into our accounting cycles in the next couple classes. Pretty soon, we're going to start to, tear the financial statements apart by line items, revenue. We'll look at assets, we'll look at liabilities. But this higher level principle, because we always have to understand controls as it relates to these different account balances and really the assertions, we're going to see that often they'll say, well, this department is responsible for that. This department is responsible for this. And what I'll point out to you is as we go through the departments, each department either falls into one of these 3 categories. It's either an authorizing department, a recording department, or a custody department. Okay, so if I tell you that the purchaser, before we purchase something, it has to be approved by our purchasing manager, and our purchasing manager is in the purchasing department, Well, that purchasing department is what? Is an authorization department. Now, the purchasing manager won't be allowed to also record the transaction. No, that would be in our accounting department. And then maybe our warehouse staff are the ones that have the actual custody of those goods when they come in and they sign those in, et cetera. So when we talk about the different departments, what we're doing is achieving a separation of duty. And what we're doing is we're separating the authorization from the record keeping and the custody. Okay, so that's sort of what we're talking about a little bit on this slide, but I like to write it this way just so that you can have a little bit of a mnemonic to remember: authorization, record keeping, custody. Okay, now when we look at preventative versus detective controls, preventative controls, hello, do what? They prevent the misstatement from ever happening. So classic example, the preventative control, just to make it very simple, you maybe have used an accounting general ledger software in the past. And if you use it in an accounting class, they probably let you make this mistake. But in the real world, a transaction would not go through if the debit does not equal the credit. So the computer will say, you try to put in, $130 as your debit, and then you put, $230 as your credit. The system won't let that go through because we know that debits have to equal credits, right? So we would put a preventative control that won't even let an erroneous transaction go through. Detective control would be designed so that, hey, maybe we couldn't come up with a preventative control, but we're going to do a trial balance. Although again, trial balances these days are just more of a way of presenting things so that we can see before we actually issue the financial statements, because most general ledger software won't let that kind of mistake go through. But just to keep it in the idea of debits equaling credits, let's say you couldn't set up a preventative control in a software that wouldn't let the debit and credit, wouldn't let the transaction go through the debit and credit didn't balance. You could do a trial balance. The trial balance would show you, hey, your total debits and credits aren't balancing for the month, whatever, and then you'd have to go back and try to figure out why that happened, which of course is everyone's worst nightmare. And that's why we have the preventative control that would not even let a transaction go through if the debits is equal to credits. Okay, but preventative versus detective. Preventative stops the misstatement from ever happening. Detective allows the company in their usual course of business. We don't want this, the detection to be a stockholder calls and finds an error in the financial statements. We want, and detective control, by the way, guys, is not the auditor. We don't sit around and get drunk and say, hey, prepare the financial statements because the auditors are going to find everything. It is so that management and employees in their normal day-to-day operations will identify misstatements through some sort of detective controls. Reconciliation of bank statement is a classic example of a detective control. Okay, so you take a look at some of these controls. Again, we are trying to mitigate the risk that we'll have a material misstatement. Okay, we'll have general control activities. General control activities are things really more preventive controls. For example, using passwords to sign into a system is an example of general control, okay? And then we will have the specific procedures that we'll put in place, and we'll want to put those into action, okay? So at this point, I'm going to go and show you this document that we had put up before, because again, it's important to remember that as we're assessing the control, and there's various ways to say control procedures, control activities on this particular example, I put the word control techniques in here, okay? But when we look at those controls, and a lot of times when my students are studying auditing, they say, oh, to just remember control activities. No, what you need to remember is your financial statement assertions, and then think of how those financial statement assertions, there could be a misstatement in the assertion, okay? For example, we're talking about the existence assertion. We're talking about sales. We think about a related account, accounts receivable. and we would talk about the occurrence existence assertion, and then we'd say, well, what would be the potential misstatement? I know that's kind of hard. You might need to put your face up to the screen to see that. But what would be the potential misstatement? Potential misstatement in the existence assertion would be that a sale was recorded, account receivable was recorded when the sale never took place. So in other words, the sale did not occur, yet it was included in the financial reports, or maybe there was some sort of return that was never recorded. Okay, now when we look at that, that's really looking at the inherent risk associated with that particular account. And so that means that you also need to consider the environment that the entity works in. And I said here that we have a competitive environment. And so maybe the company, because they're in a competitive business, competitive environment, they're going to maybe want to overstate their sales a little bit, right? For completing this assertion. So we think of that potential misstatement, what could go wrong, and then we sit there and we look at the control technique. Okay, in other words, we have to assess our inherent risk, our control risk, right? You can see across the top there. And this is all done during the obtaining the understanding phase. So in this particular case, I didn't have good separation of duty. The same person that was responsible for making the sale also implemented the control procedure, carried out the control procedure, which was to call the customer to see, hey, were they satisfied with goods? Because the control procedure, although it sounds kind of operational, how'd you like that new thing? In other words, our staff, or our customers, excuse me, happy with their product? So that sounds like an operational objective, which it could be an operational objective. These control procedures, remember, the control procedures went across the objectives, right? So you could have an operational objective here, but then the reliability and financial reporting objective is that the customer could say, I never bought that. No, what are you talking about? I never received that. What? We follow up, there never was a sale, right? But if the same person who recorded the sale, right, for separation of duty, record keeping, in that case, custody would be combined as well, and that they are kind of in custody of that customer, right? In the dialogue with that customer. Okay, and so what happens? We combine the record keeping, the custody. Then what happens? We have poor separation of duties. So when we make our assessment of the risk and material misstatement, notice I've assessed the risk and material misstatement at high. I said, Blake, there's not good separation of duties here, so I don't like the design of this control. And then maybe I did a walkthrough where even if I did like the design, which I don't like the design of this, but when you do the walkthrough, you sometimes see that people that are responsible for carrying out the control, even if there was good separation of duty, they don't understand the responsibility. That's why it's important that we have the information communication so individuals understand their responsibility. Okay, so in this case, I didn't think it had good design. I didn't think it was implemented, and it's got to be both anyway. In this case, I had it be both just to, emphasize the point that it has to be both design and implementation, but I had it that we don't like either. So what do? We assess the risk and material misstatement at the maximum. If you assess the risk and material misstatement at the maximum, both for public and non-public companies, you would bypass the testing of the operating effectiveness. No, there's no control test. And now I'm going to need to lower my detection risk through the timing, extent, and nature of my substantive procedure. And notice in there, I'm taking big sample sizes. I'm using confirmation. Confirmation is getting external evidence, right? I'm sending out a letter to my clients' customers saying, do you owe so much money? And in there, I'm confirming both the account receivable balance, but I could call out specific transactions in that confirmation. On January 11th, you purchased this. Is that correct, right? Of course, it's a little bit hard to ask something that specific. You might need to be a little more general than that, because a lot of times your client's customer doesn't sit there and hold records forever in case you come along and ask a question at some point in time. So you might have to ask a question about a transaction that your client's system would have information available. And they're not going to sit there and hold every single transaction just for when your wonderful auditor comes along and asks a question about something. So you probably have to be kind of careful. But my point being that you could confirm you're going to have a large extent, and you're going to be doing that testing at year end, and you're using external evidence, again, nature, extent, time. Now, in this second row, and these would be mutually exclusive, I'm saying, well, what happens if you have good separation of duty? Instead of the person that made the sale, it's a sales manager that follows up with the call. And the sales manager records that call in a log. And then a little bit later on, somebody from the internal audit department comes through and samples a few of those calls and sees if they got the same result when they made the call. So now we've got our internal auditors involved. They report directly to the board of directors. We talk to the board of directors. Have you received any internal audit reports with concerns in this area? Are you concerned about the competitive environment that you work in? That sort of thing, to make sure that we have that overarching good control environment. We look at all that, we're satisfied with those things. So what happens? We see that the control has good design, and we saw that it was implemented. During our walkthrough, we may even be involved in a couple of the calls. We may say, hey, do you mind if I make the next call? Definitely by the time we're getting to our testing of the controls, we're doing what? We're sitting here now, and because we've assessed the risk and return statement at less than maximum, we have to test the operating effectiveness of controls. And so we're going to be pulling some of those sales logs, looking to see that they're signed off on. Now we have evidence of operating effectiveness, and we complete our testing phase. And notice now in our testing phase, we've added what? We've added the testing of the internal controls as well as our substantive testing. We're now in our further audit procedures. We're in our testing phase as we bring down our control risk and our detection risk. Notice our column is smaller now, so we're using not as much extent. This is probably a good example of extent. We're not using as much evidence. We're still confirming, so we're still getting some external evidence, because for accounts receivable, the standards pretty much expect that you should do confirmation. We'll talk more about this later. However, if you can't do confirmation for some reason, there are ways around that. But again, that would probably be a situation where you have a lower risk and return statement. So I stuck with external evidence, but notice now I've done some interim testing, and my sample sizes are not going to be as big, so extent and timing have come down. Question on this thing? Okay, just to back up a little bit, guys, I think you can see if you had a little trouble with midterm one, two key areas. I mean, the real key area is that what? The audit risk formula, okay, and also the steps in the internal control process. Obtain understanding sufficient to evaluate the design, determine the controls have been implemented, and then we make the assessment of risk and return statement, and we determine our timing, extent, and nature of our further audit procedures from there. Testing the operating effectiveness of the controls, if we've assessed the risk and return statement at less than the maximum, and then always doing some level of substantive testing. So that's key. And then understanding the audit risk formula, again, IR times CR times DR. So that's why I'm willing to give you an opportunity to get a better grade on midterm 2, on midterm 1, if you do better on midterm 2, because we're going to continue to leverage off of some information that we learned from primarily chapter 4, I think is where most of the stuff came from. Question? Okay, good. Again, separation of duties. We are separating what? The authorization, okay, the record keeping, and the custody. Okay, so just remember that arc. And again, as we get into the specific accounts, we'll talk more about separating these. Okay, information communication. Okay, information part of this, making sure our accounting information system has the proper controls in there, preventative controls, detective controls. Okay, for example, that making sure that debits and credits equal in any transaction. Communication now says, hey, you have to communicate to the staff their responsibility in order for a control to be implemented, right? So I have to understand what I'm supposed to do. You know, This applies to auditors as well. I would tell newer staff, I'd say, hey, why are we doing this procedure? Why are we doing this? And they'd sit there and look at me. I don't know, because it said so in the audit program last year. If you don't know, now this is looking from the standpoint of an auditor, if you don't know why you're doing an audit procedure, you're not doing your job. You have to be able to say, we're doing this because we're testing the existence assertion. I'm doing confirmation because it's external evidence, and I'm looking to make sure that that transaction actually occurred, existed. If you don't know why you're doing a procedure and you're just sort of doing it because the audit program says you're supposed to, then you really aren't doing your job as an auditor. Well, the same thing for the staff now of our audit client. The individual that's implementing that control should know what the control is trying to achieve, right? And so that's all part of it. And in the walkthrough, we would be looking at that to see that the control is implemented. And I've been on engagements where halfway through the engagement, you're kind of helping the person along to say, okay, well, you're supposed to file this, you're supposed to do it that way. And you're doing that just to kind of move that situation along. But your assessment risk and material misstatement is probably going to be at the maximum because you've now determined that someone doesn't know the procedures. Okay, so it's information and communication. Okay, so it's making sure that the staff understand their responsibility, okay, with external parties, but also internal communication of the responsibilities for those individuals. Okay, monitoring, finally monitoring, and okay, I guess this is a mnemonic, PSFFA, which I don't know because they capitalized each one of those. And it looks like they were trying to come up with a mnemonic, but I can't figure out what it is. The most important thing here is the monitoring is really done by the internal audit staff. Okay, that's what they're doing. They're monitoring the internal control. They're looking at the control environment, the risk assessment, information communication, the control procedures. Okay, they are the monitoring, and then they're reporting back to the board of directors so that the board of directors then can what? Board of directors is part of the control environment. They touch all the other aspects. So they would then do what? They would say, okay, our internal auditors reported to us some problems. Okay, we see what we're identifying the risks for our financial reporting. What are we going to do? We're going to put control procedures in place that'll prevent or detect those problems from happening. Then what? Then we're going to make sure that everyone understands their responsibilities, communicate, information system. We'll put some automated controls in there, etc. And then we'll continue to monitor that. So the whole process, that's why I said you could put in a circle, but I don't like to put it in a circle because control environment is supposed to be over all of them. But that really is the way the process is supposed to work. Okay, and so monitoring is done, and again, the internal auditors is really the key piece of that. And again, sometimes students will say, well, what if you don't have internal auditors? It's a small entity. Then members of the board of directors should be accomplishing that function. Maybe one or two members of the board of directors will come out and do some of the internal audit function. Okay, question? All right. So just taking a look here, do we freeze up? Interesting. Okay, there we go. My internet. Yes, no, maybe so.
We lost the screen share.
Oh, yeah. Okay, yeah, I think my internet did a number on me for a second there, guys, but I will get back in. There you are. So let me just do the screen share again. I think my internet did a little pickup there for a second. We're good now, right? Okay. So limitations of the internal control. Okay. You can never design a perfect internal control system. That's why control risk can never be zero. Okay, because there's always some potential, right? None of the elements of the audit risk formula can be zero, because that would mean our audit risk is zero. That would mean that we'd be able to provide absolute assurance. And remember, we said we're providing what? Reasonable assurance, right? Reasonable assurance, because what? Because you can never design the perfect audit procedure. So your detection risk could never be zero, because what? Because we use sampling often for our substantive tests. So there's always a chance that the sample will not be representative of the population. But then there were the non-sampling components of our detection risk, which included things like fraud and error in applying the audit procedure, that sort of thing. Well, control risk is also not going to be zero, because controls have what? Limitations, human error. Somebody just makes a mistake in applying the control. Deliberate circumvention of the control, collusion. Two employees conspire together to authorize a transaction and have the custody of the assets. I don't know, I guess I can share this story. I had a, girlfriend, okay, I'll share the story here, that she got involved. She worked at, it was called Price Club back in the day. And she worked there, and she was responsible for the reconciliation of all the cash during the day and whatnot that got processed during the day. And then somebody else was a cashier. Well, she made the mistake of, doing a little scheme where she worked with this person and they did some erasing and that kind of thing. And she eventually got caught, but the problem was they got away with, they got fired. They got away with some money because they sat there and had colluded essentially to override the authorization and custody controls. And so, so if you have something like that and people are slick enough, you can never overcome that. So there's the that limitation on internal control. That's employees maybe doing that. Management override of controls. This is probably the more, this is the kind of stuff that makes the financial press. Okay, this is where the management of the company is involved. It just tells employees, hey, go ahead and record this transaction. Don't worry about the control. You need this job, don't you? Okay, so somebody tells them, don't worry about reconciling this. I'm the boss around here. Now, the auditor would potentially be able to detect that, because you would look for the actual control being implemented. And if you're seeing it's not implemented, you're saying, well, why isn't this being implemented? And then you find out that there's been some sort of override. Okay, so circumvention, collusion, management override, these are classic examples of the limitations of any system of internal control. This is really why our professional skepticism is so important, right? Okay, we always have to keep that in mind. Okay, good. Document the internal control. We have to document our understanding. So remember, we said obtain an understanding sufficient to evaluate the design of the control and determine that the control has been implemented. So we kind of went through and we talk about how you can document that. You have to document that. So remember, on every audit, obtain an understanding sufficient to evaluate the design. Determine the control has been implemented. Make your assessment of your risk and material misstatement. You make that assessment at the maximum, follow the red arrow, go straight to substantive testing, right? If you assess the risk and material misstatement at less than the maximum, follow the black arrow, in which we're going to first go ahead and do our testing of the operating effectiveness of the control. And then we can go ahead and do always have to do some level of substantive testing. But again, our nature, extent, and timing, nature, internal evidence, extent, smaller sample sizes, timing, doing year-end testing instead of interim testing, but you always have to do some amount of control. Some amount of substantive testing. Control testing you could bypass, right? If you've assessed the risk and return statement at the maximum. Okay. Now, again, we say that when should control tests be applied? Again, if you've assessed the risk and return statement at less than the maximum, you're going to want to test the operating effectiveness of the controls. Okay. Unless you're in a non-public company environment. If it's a non-public company, then you could, if you determine it's more efficient to do so, you could bypass the testing of the operating effectiveness and go straight to that substantive testing, even if you had assessed the risk and return statement at less than the maximum, if you determine it's more efficient to do so. That is highly unlikely that's the case, because if you assess the risk and return statement, you have the opportunity to assess the risk and return statement less than the maximum, but you just say, I'm not testing operating effectiveness, and you go straight to substantive testing. Now you have to use external evidence, larger sample sizes, do your testing at year end, and that tends to be a more inefficient way of completing the audit. But if you're in a rare circumstance where that's the case, for a non-public company, you do not have to test the operating effectiveness of the controls. If we're talking about a public company and you have looked and you have assessed the risk and return statement at less than the maximum, then you would have to test the operating effectiveness. That's if you have assessed the risk and return statement at less than the maximum. The PCAOB standards don't have you go around testing operating effectiveness of control that you've already determined to be ineffective because of the design and or implementation problem. But if you have assessed the risk and return statement at less than the maximum, then you would need to test the operating effectiveness of those controls, because that's going to be the evidence that will support your opinion on internal control. Question on that? That gets a little bit tricky to understand. Okay. So you test the operating effectiveness controls to support a lower assessed control risk, right? If you have liked the implementation design, you've assessed the control risk less than the maximum, and you're going to not move directly substantive testing for a non-public company, test the operating effectiveness. Public company, you've assessed the risk and return misstatement at less than the maximum, you must test the operating effectiveness. I might ask you a question on that, guys, so make sure, because I know that gets a little freaky, a little weird. Okay. Okay, good. Let's go ahead then and take a look at the way to document the internal control. Okay, so we've said you can use flow charts. You could use a narrative description. Okay, flow chart is a little better to use if you have a fairly complex system. Okay, narrative is usually a write-up. This department does this, then that department does that. We had a policy at GAO, Government Accountability Office, where I spent years working as an auditor. We had to use narratives. They called them psycho memos, and it was ridiculous. It was a requirement that I hope they've changed since the years. I've been out of there for about 6 years. But nobody wanted to read a psycho memo. I used to call them psycho memos, because they'd have these elaborate systems and have a 300-page psycho memo. Who was going to read that? Nobody. So we would, you would just go to the person that was on the audit before you and say, what are the key elements here? For a complex system, flow chart is a better way of documenting your understanding. Now, what happens these days is the client knows that, there's going to be rotation of auditors, and these, newbies are going to come in and start asking all these questions. And rather than sit there and have to re-explain everything they say here, they've written up the controls and they just hand you that, and they document in the areas that have changed. They highlight in the areas that have changed since the last audit, and you can have that in your work papers as support of your documentation of your understanding. There's also something called questionnaires. Questionnaires tend to be yes and no type questionnaires. A yes is good. That means that the control is achieving the objective. A no is bad. And if you have a sufficient amount of no's, then that's a critical amount of no's, critical mass of no's, then that would mean that the control is not either implemented properly or designed properly, and you're going to assess your control risk at the maximum. If you have the few no's, that's okay. You don't want a lot of them. We're looking for mostly yeses. Then that would document our understanding and that the control achieved the objective, and then we could assess our risk material statement at less than the maximum. But you must document the understanding. You absolutely have to document the understanding. And so we give you an example here of how you might document that. Okay. That's a questionnaire. Okay. Depending on the size of the entity, obviously we have some entities that would have much more sophisticated controls than others. Okay. And we've talked about the limitations. Okay. And part of why I'm speeding through here, let me just find what I want for a second, then I'll come back to these. Okay, what I was trying to get to, I'm just going to put it up. This could be your documentation of your understanding. Okay, and that what we've sat here and we basically have obtained the understanding, and we've documented what we've understood in our risk assessment, et cetera. So you don't have to use those questionnaires. What I like about, I guess I like it because this is how I would do it, okay, is what I like about this is I've called out the control technique and my assessment and what assertion and my substantive procedure where I did my control testing. And what I would do is I put work paper references alongside my control test and my substantive test. That way a reviewer, when they're saying, okay, if I'm under peer review or something, and someone says, well, did you follow the standard to document your understanding? Yes, I did. Go to, this is almost a lead sheet approach. Go to lead sheet 1A-1, where I talk about did you relate it to the assertions? Yes, I did. How does it relate to the financial statements? Well, I could have another column. I mean, I don't have to have another column. I have a row right here that says this is the sales on my income statement. So they can literally go through and follow through your work with something like this, which is kind of like a lead schedule. So that would be a way of documenting that you follow the procedures. Okay. So now that I kind of got that out of my head, I can slow down a little bit. We talked about these. Okay. We talked about, well, these are the nature of controls tests. Okay. Because when you have the assessment risk material statement, you have to test the controls. And this is the nature of control tests. Now, I'm going to put them on this pyramid here, okay? Because what happens? Okay. You're sitting there and you obtain an understanding, you like the design, you like the implementation of the control. So now you have to make your assessment of the risk and material misstatement. Okay, now you could assess the risk and material misstatement at maximum. If you do, that means you didn't either like the design or the implementation. If you don't like the design and implementation, you assess your risk and material misstatement at the maximum, you don't do any of this, right? You don't test the controls. But if you like the design, you like the implementation, and you assess your risk and material misstatement, say at moderate, what happens? Well, now you're going to have to get enough evidence to support that, and you start to look at your test of your controls. Now, you would maybe be able to have a moderate sample size, okay, to support that moderate assessed control risk, and you could get some forms of evidence that are lower on this pyramid here. So maybe you're going to inspect some of those inventory sheets or some of those call logs that we talked about. You're going to observe, you're going to do a walkthrough and watch a few folks doing the transaction and make some inquiry, but maybe you don't have as much re-performance, right? But let's say I wanted to assess that control risk at low. So I'm going to go from moderate to low. Well, now the expectation of the standards is you're going to have more of the stuff higher on this pyramid. So now I'm going to do more of that re-performance. Remember I said in the case of the call log for the sales matrix that we had up here a little while ago, you know, this is my favorite document right here that I was talking about, okay? When we did this, we also participated in some of the calls. So if I'm trying to assess the risk in the chairman's statement at, say, low, or the control risk at low, then I'm going to probably do more of those calls. I'm going to do more reperformance, because think about it. That's the best internal control evidence that you have the internal control has operating effectiveness. Because what did you do? You got on the phone and you called the client's customer and you spoke directly to that client's customer. Well, now that's knowledge that is the best knowledge, because the auditor participated directly in that call, called an individual did that independently. Now, that's not to say that you wouldn't also observe the clients, the sales manager or whatever making the call. You do some of that. You'd still inspect some of those call logs to see that they were signed off on. You'd still do some inquiry, talking to the board of directors and that, okay? But we expect you to do more reperformance the lower you're trying to get that assessment of control risk. So it's not good English, but I think it makes the point that you are trying to get more better evidence that the control has operating effectiveness, the lower you try to get that control risk. More meaning what? Now, instead of maybe looking at, if I was at moderate, maybe I look at 50 call logs to support a lower assessed control risk. I'm gonna look at 150 call logs in my inspection. So I'm looking at more items. And what I'm doing more reperformance. So I'm also making a bunch of calls myself to reperform that. And that would then help me to support that lower assessed control risk. Okay, so more better evidence. You're going to have what? Larger sample sizes for your control testing. You're going to have what? More reperformance. Inquiry alone is never sufficient to support a lower assessed control risk. You cannot just do inquiry and say, okay, there. That inquiry, yes, you can add that to your operating effectiveness testing, okay, the inquiry, but it's really designed more for the obtaining the understanding phase and not so much for the testing phase. And by itself, it will not support a low assessed level of control. So you have to combine it with one of these others. Question? Okay, now we're not going to talk about this so much right now. Well, notice this is the hierarchy of evidence for your control test. We have a similar, okay, listing for evidence for our substantive test, okay? And so what happens is auditors direct personal knowledge, okay? If you go and you actually calculate something, okay, management uses an estimate for what they think the allowance for doubtful accounts should be, but you go and you recalculate that, that is probably the most persuasive evidence. That is the most persuasive evidence, not probably, John. It is the most persuasive evidence. It is auditors' direct personal knowledge, okay? The next best evidence is external evidence. Now, when we talk about external evidence could fall into two categories. External evidence that the auditor gets directly from outside the entity. For example, a confirmation from the client's customer that's sent directly to the auditor, okay, or a bank confirmation is sent directly from the bank to the auditor. But you could also have external evidence that is indirect, meaning that the evidence came from outside the entity. For example, they hand you their bank statement, but the client already had opened and maybe reconciled on the back of the bank statement and that. So even though it's external, because you didn't receive it direct, it is not as high on the hierarchy here as would be external evidence that was received directly by the auditor from outside. Internal evidence, for example, an invoice, okay, and then oral evidence is the least effective, so, or least persuasive, I should say. So, you know, you could ask questions about different things, etc., and use that somewhat, but you'd have to combine it with some of these other forms of evidence. And again, the lower we're trying to get that detection risk, the higher we are, the more persuasive evidence, looking for more direct personal knowledge. If we can accept a little lower excuse me, a little higher detection risk, then our substantive testing starts to come down and we start to move down this hierarchy of substantive evidence. So I put these two slides together because they really are very similar in how we look at the evidence to support our control risk assessment, how we use them to control our detection risk. Question? Okay. Okay, well, that's the end of chapter 6. So what we're going to do is take a quick break. Why don't we come back at 7, okay, guys, so that we can, what time do we get out?
8:10.
8:10, okay, so we got a little time. So I'll tell you what, rather than rush it, let's come back at 7:05, okay? We'll give ourselves a full, pretty close to a full 10 minutes, or a little over a full 10 minutes. We'll come back and we'll pick up chapter 5, okay? Hey, can you hear me now, guys? Yeah, okay. Okay, good. So why don't we just go ahead and jump into chapter 5. And I'm not going to go through some of these first few slides because we've just gone through them. I had them in there because it's anticipated that, you know, we would maybe be doing this in a separate week or something, but we've gone through those here just a couple minutes ago. So I'm just going to go ahead and jump down to this slide here for chapter 5. Okay. And again, when we talk about our audit procedures, remember we have to obtain an understanding, as we've said. We have to make the assessment of risk and material misstatement. When we get to our further audit procedures, that could include testing of the controls, and then it will always include some amount of substantive testing, right? So let's talk about where we will list out our audit procedures, and we'll list them out in a written audit program. It must be written. It must be written. And when we look at audit procedures, remember, we always look at them in terms of what is the best procedure related to the assertion. Now, as we get into our various account line items on the financial statements, I will keep reminding you that we're not so much auditing accounts receivable, we're auditing the assertions around accounts receivable. So we're auditing existence, and we select a procedure that's good for existence. And for existence, the best procedure is to select a sample of items from the financial statements and then find evidence outside of the financial statements that supports the existence. Confirmation is the classic procedure there, where you send a confirmation letter to your client's customer and you say, do you owe $25,000? If they say yes, you've proven that there is a customer out there that's connected to that account receivable. So they said yes of $25,000. But does it support the valuation assertion? We've talked in here, the answer is no, because even though the client's customer may be saying I owe $25,000, and that may sound like valuation, it's really not, because maybe the client's customer can't pay. And so you would have to do some procedures around the allowance for doubtful accounts. And the classic example there would be to look to see what the aging of the receivable is and see if you feel they've put enough in the allowance, depending on how current your client's customers are on paying these receivables. This is recalculating, okay? And recalculating, by the way, confirmation is what? Obviously external evidence. Recalculating is going to be our direct personal knowledge. If you sit there and you recalculate what you think should be the amount of the allowance, that's your best evidence here over the valuation assertion. Okay, so again, what this table, this slide is doing is just showing you example of assertion and then a example audit procedure, but these procedures are substantive procedures. You not only do substantive procedures around your assertion, you also do control procedures around. So again, when we talk about further audit procedures, that you can see right here, okay, further audit procedures not only include testing of the substantive testing of the account balances, but it also includes what? Control testing. But again, you only do that control testing when you have determined that the control risk is less than the maximum, the risk of material misstatement is less than the maximum. But notice I line up my substantive test that we saw on this slide, but I also line up my control and my control testing, if I choose to do it, with the assertion as well. So you're looking for control that will be effective in preventing or detecting the misstatement and that assertion. So we have the account balance, we have the assertion, we look for controls that will prevent or detect that misstatement, right? Okay, we make our assessments around that, and then we test the operating effectiveness of those controls. We do always do the substantive testing. Okay. Okay, good. Now, when we look at evidence, again, we had the slide from the chapter we just completed, the hierarchy of evidence. So the lower I'm trying to get that detection risk, the more direct knowledge I'm looking for, the more external evidence. If I can accept a higher detection risk, maybe I'm using some internal evidence, some oral evidence, but I can never just rely on oral evidence. I will always have to combine oral evidence with one of these other forms of evidence to get an appropriate reduction in my detection risk, to have the proper amount of substantive testing. And again, as we said, we have a hierarchy also. I put it on this kind of poor depiction. This is supposed to be a pyramid, okay? And so you can see the top of the pyramid is going to be reperformance. Okay, that's where I will reperform the control, participate in those calls. That is the best evidence that the control is operating effectiveness, versus simple inquiry. Inquiry really is used more in the obtaining the understanding phase, but I could use some of what I learned through my obtaining the understanding as evidence to lower my control risk as well. But I'd have to combine with some of these others, like observation. That's when I do the walkthrough, which also, by the way, you do that during the obtaining the understanding, but that doesn't mean that you can't use your inquiry, your inspection to help lower your control risk. And just let me explain that with a specific example. Let's say I'm in the obtaining the understanding phase and I'm saying, okay, tell us about the controls. They tell me, I look at the design. Okay, well, the fact that I like the design is already trending me towards that lower assessed control risk. Then implement it, I do a walkthrough, right? I observe the entity performing the controls. Well, what's happening here? Now I'm seeing how the employees actually interact, and I'm really making getting assessment for the human element there. And that's the best way to do that, is through inspection, and even though, through observation. And even though I may do that during the obtaining understanding phase, I don't have to throw away that knowledge that I gained. Okay, and then you get into inspection. I could do some inspection where I actually will look to see if there was sign off on those inventory sheets, that kind of thing. So again, this does start to become more of an art than a science, and how you put together the information you need for your control testing. You can never just rely on inquiry alone, though. Okay. Okay, good. So, of the following, the most reliable type of evidence is, and you know, what I don't like about this is it combines both control evidence and substantive evidence, but the correct answer is reperformance. So this I put as a hard question because it's combining both of these things, right? It's saying, giving you some example of evidence for both your substantive test and your control test, but of these, reperformance is the best. Now, I couldn't give you a question like this where I put auditor's direct personal knowledge and reperformance, because that would then be what? That would be a tie. And so you wouldn't be able to say which of these is the best. Question? That's kind of a hard question. I don't know if I'd ask you that one on your exam. I might, if I'm in a bad mood. Okay, when I prepared the exam, I might ask you that. Okay. Okay, good. Of the following, which is the least persuasive type of evidence? Okay, documents mailed by outsiders, that's external evidence, right? Correspondence between the auditor and third party, external. Computations made by the auditor, that's auditor's direct personal knowledge. Computation, copies of company sales invoices inspected by the auditor. Well, that's documentary evidence, but it's what? It's internal evidence, so it would not be as persuasive as these other three. That one's a little easier. Of the following, the most reliable. Okay, that question is so great, I had to ask it to you twice, right? That's the same question. So note to self, delete that slide, the same question twice. Okay, let's try this one. Which of the following statements concerning audit? Oh, darn. I forgot to do the poll, but the poll wouldn't be very good here because I've shown you the answer, so never mind. Maybe we'll do some polling questions next time. Okay, which of the following statements concerning audit evidence is correct? Appropriate evidence supporting management assertion should be convincing rather than persuasive. You know, that's what we got to get away from. It's what? It's reasonable assurance. It's professional skepticism. It's what? You know, limitations on the internal control. Limitations are substantive tests because of sampling and non-sampling issues, right? So it's a lot of, I think, you know, we're thinking, oh no, auditors, no. No, not necessarily. Use all these, you know, direct personal knowledge and recalculation, all these kind of words. And then at the end, you say, but we're not sure because there's these other factors, right? So we're not looking for convincing, we're looking for what? Persuasive, okay? Effective internal controls contribute little to the reliability of evidence. Come on. Effective internal control, we do what? We lower control risk, we lower our risk of material misstatement. Now we're what? Now we're more comfortable accepting some more of that detection risk, right? Okay, but we never want to hide detection risk. The cost of obtaining evidence is not an important consideration. Yes, it is. Yes, it is. I mean, you know, if you're an auditor, let's face it, there's no kid grows up saying, mommy, you know, that, what is that guy man doing? That, what is that person doing that looks like so much fun? Oh, that's an auditor. Okay. Nobody dreams about being an auditor. But when you see someone walking in a nice house or something, you say, well, what does that person do? Well, that person's an auditor. Oh, okay. Maybe I like that. Right. Okay. So we're doing this, you know, you may love the work, but we're doing it for profit. Right. So no. The cost of obtaining evidence is absolutely consideration, right? And then this last one, a company's accounting data cannot be considered sufficient audit evidence to support the financial statements. Yeah, okay, that gets a little confusing, okay? Because we say, well, wait a minute, a company's accounting data, what is that? The accounting data is just the information that's sitting in the general ledger. Okay, that's the accounting information. We just don't rely on what's in the general ledger. We look for something called corroborating evidence. Corroborating evidence supports the accounting data that's sitting in the general ledger. So what corroborates the account receivable accounting data is what? Is the confirmation. Is the auditors, you know, they have an amount of allowance for doubtful accounts. But that in itself doesn't support the opinion. It's what? It's the corroborating evidence. It's the auditor's recalculation. Okay, so accounting data alone is not considered sufficient support for the financial reports. It's how do you corroborate that data through your audit procedures, your confirmation, your inspection, those sort of things. Okay. So I guess that one's a hard question too. Sometimes with some of these auditing questions that you'll see on your exams and stuff, you have to take that sort of process of, you know, elimination. Wait a minute, I know these other three are correct. So it's got to be this last one. Okay. Okay, again, we gather evidence. Don't forget, guys, around the assertions, and I'm not going to go back through this. I think you're probably getting tired of seeing this slide by now. Okay, again, when we talk about our assertions, the two classic assertions that I see asked about in questions all the time is existence and completeness. Okay, so for existence, we're going to do what? We're going to start from the journal and go and find the supporting documentation, right? If we're talking about completeness, then what? Then we go from outside of the journal and then try to take that back to our accounting records, right? So I think I gave the example in here for sales. If we were, when I say in here, I mean in the previous section lecture, one of our chapters for existence, I did what? I pulled an account balance for a particular client. I sent out the confirmation. It came back. Yes, I owe $25,000. That supported that that transaction actually existed. For completeness, what I did was I found the shipping document. I matched that to a sales invoice, and then I went back and tried to find that in accounting records to see that the accounting records were complete. And maybe when I do something like that and I come back and I say, hey, we have this document, you shipped the goods, but how come there was never a sale that was made on that? Then what? It was recorded on that. Then the client says, oh yeah, thank you for finding that, whatever. I found out that the records were not complete. Now I'm doing a lot of talking today, so let me pause for a second. Which assertion did we say is more scary for auditors? Occurrence or completeness?
Completeness.
Good, yeah, that's right. Completeness, right, Davi, was the more important, just because we have we have this little financial statement here, and we're trying to make sure everything that possibly occurred out there, I shouldn't say occurred, but everything transaction that happened out there, it should be included. It's very scary to make sure the whole world that should be captured here properly got captured, right? So completeness is the tougher one. Okay, good. Okay, good. Now you come over and you take a look at some other procedures, inspection of tangible assets. Okay. Again, if I'm looking up something and it says on the financial statements that there should be a robot here, I go and I do what? I find the robot. There it is. Okay, this robot actually, that helps me with existence. But it could also help me with something like what? Valuation, if I look in the things damaged, or it could help me with obsolescence. Hey, how come this robot's been replaced? How come you still have this old robot? That needs to be devalued on the financial report. So you could have a procedure for each assertion, but you could also have a procedure that does what? Answers more than one assertion, going and finding it, answered inspection. It answered what? It answered valuation in that case. Observation, observing and watching the procedure being performed. That really observation is what? More consistent with our internal control. Okay, remember we said observation was one of the pieces of evidence you could have, walk through when you're looking at the internal control. Inquiry, again, inquiry really is going to be used for obtaining an understanding phase of the internal control. So you're saying that we've sort of lined these up here on some of these slides of evidence, what the evidence falling into evidence for substantive procedure, the evidence for control procedure as well. Okay, confirmation, guys, is the classic procedure for accounts receivable, external evidence through confirmation. Okay, but you could also use it for cash balances. Some of these others they list here, it depends. Well, for example, would you want to use just confirmation for accounts payable, for bonds payable, for liability? That's a question. Confirmation is doing what? Looking at the financial report, finding a transaction or finding an account balance, and then going and saying, do you owe this amount of money, right? So that's getting external evidence where we're pulling something from the financial reports and asking about it, right? Now, if you do that with a liability, and now you're saying, okay, you're sending a letter to your client's vendor now saying, does my client owe you a certain amount of money, right? Okay, maybe you're saying, fill in the amount that they owe you, whatever. Okay, now, you just tested what assertion if you do that. I went and I found the amount that is owed now. I went to my client's accounts payable.
Existent?
Good, I just tested existence, excellent, because I just went and said, okay, are you out there, right? But as an auditor, are you more concerned that your client listed all the liabilities, or are you more concerned that there were some liabilities out there that they did not list?
Concerned about the missing or
probably
potential
not
missing.
Yeah, you're worried about, hey, is there a liability out there that they didn't put down? Well, that's the existence assertion. That's the completeness assertion, isn't it? There's something that they should have included that they did not include. That's this scary completeness, is everything is supposed to be here. Well, confirmation is designed around what? Is designed around existence. So even though, yes, you could use confirmation for a liability like account payable, in and of itself, if I was reviewing your audit work, if I was doing a peer review and all I saw was that you use confirmation for your liabilities, I would say, you're probably should have gone back and done some other procedures along with confirmation that would have given you audit evidence. So for example, and we'll talk about this more when we get into liabilities, but I'm just trying to get around how we think about assertions here and give you this example here. For example, what I should probably do is look at disbursements that were made in January and February of the next year and see these disbursements that are in the financial information for a different year, for year 2, and then try to take that back to see if it was recorded as a liability in year 1. Because if they dispersed in year 2, well, why did you disperse in year 2? Oh, well, we owed some money. Oh, well, when did you owe that money? You paid it in January 1st. You must have owed that money on December 31st. Wasn't listed as a liability on December 31st. Now I've got a good procedure around the completeness assertion. Notice I went outside of the financial statements. I looked at disbursements that were made in year 2 and tried to find evidence that they were properly recorded in year 2. In year 1 in that example. So again, confirmation, yes, is a procedure that can help you with these different accounts. It lends itself more towards it lends itself to the existence assertion, and therefore is more valuable as an auditor for things like assets than it is for things like these liabilities, accounts payable, bond payable, etc. Question? Okay, good. All right, let's take a look at some of these others. Recalculation. Okay, recalculation is really going to be something that we would use for accounting. I think I wrote accounting, and I think I never got a chance to write the second word here, which is accounting estimates. Okay, financial reports are full of estimates. Depreciation is an estimate. The amount that they put in the allowance for doubtful account is an estimate, and the best way to audit estimate is to recalculate. If after you perform your auditor's recalculation, direct personal knowledge, you come up with the same amount that they put in for their depreciation, for their bad debt expense, for their allowance. Okay, reperformance, as we've seen, is a classic internal control procedure. Reperform the procedure. Get on the phone and call some of those individuals yourself and see if you get the feel that that's a control that has both good design and is having operating effectiveness. Could you participate in a few of those calls yourself? Okay. Okay, good. Analytical procedures. Remember, we must do those in the planning phase, final review phase, but we may, if we want to, use analytical procedures, some of my substantive support. So remember, if this is my substantive testing, okay, so that's my substantive testing, most of this would be filled up with test of details. Test of details. Come on, pen. Really? Most of that's going to be test of details, is what that's supposed to say. Okay. But some of it can be analytical procedure. Really? Is my pen really going to crap out on me in the middle of the class here? Okay, so most of that would be test of details, but you could, that one spot is supposed to be analytical procedures, and I don't know why my pen stopped working on me, so it is what it is. Okay. Okay, good. Now, when we talk about, well, maybe my screen froze. Can you hear me? You
Yes.
can't hear me, but,
Yes.
okay, but I got a lockup on the computer. That's the problem. So what does that mean? Okay, guys, I'm gonna have to reboot because my computer locked up on me for some reason here. So yeah, I don't have any other ways, means of advancing the slides here. So hang tight, I'll be back. As they say, you'll still see me because I've got a separate camera here, but I can't advance the slides on this one. So you'll see everything will go away here and then I'll be right back, but I'll still be here. You just see me messing with this, okay?
No, 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 mommy school, no touch. Ê đau ấy đừng. That's fun. Sure. Yeah. Yeah.
Okay, you can hear me okay now? Um, Let me just bring the slides back. Are you kidding me?
Oh yeah. That's it. Oh wait, I want this one. You want that one? Okay. You wanna watch that one? Here. What is it? Is that a game? Game? Huh? Okay, I'm sorry.
Okay, guys, we're gonna have to call it a night because the meeting is already running, it won't let me. It thinks I'm not the host because the meeting is already running. I don't even know how to end this meeting now. So I just can't. I can't share my screen with you because it won't let me because apparently now I'm not the host. Because the meeting has already started and I'm trying to come in.
Professor,
Uh-huh.
it looks like I became the host. I don't know how. I just realized now. So I don't know what should I do next. I'm trying to make you host, but it is not showing me anything.
If you go to
Mhm.
share screen, if you click on that, it should show that you can allow others to share screen.
Okay.
Next to the share screen, or actually there's other options maybe where it says let others, but I think it's on share screen. If you click on that, if you click on share screen, There's a, oh, here, I got it. Okay, I think you did it. Yeah.
Okay. Uh-huh.
Okay, cool. Great. Thank you. Who was that?
Okay. I'm Priyanka.
Thank you very much.
Yeah, welcome.
Get by with a little help from our friends, right?
Okay.
Okay, good. So I'm gonna just not repeat the analytical procedure. I think you understand that we could use analytical procedure as some of our substantive evidence. They allow us to do that. Most of our substantive evidence will be through test of details. Confirmation is classic example of a test of details, but you could also supplement that if you want to with analytical procedures. And there's some accounts that you want to use analytical procedure because there may not be the evidence for a test of details. Or if your risk of material misstatement is low, this gets into nature. We don't have to use as an effective procedure, so we could use something more high level like an analytic. We talk about that. I think that's chapter 3, I want to say, where we did the washing machine revenue example. Okay. Okay, good. Thanks for your patience, guys. Let's go ahead and let's take a look here at audit documentation. Okay, we have to have audit documentation that will allow an experienced auditor to be able to review the work that we did. And I would sometimes tell folks when I would be reviewing their work papers before we had a second experienced auditor come in and look at things. Hey guys, you've got to document what you did, and it has to be clear the procedure, what the objective procedure was, what the results of the procedure was. Okay, you can't staple yourself to your work papers. Okay, so it has to demonstrate compliance with the professional standards, support conclusions, that sort of thing. Okay. Now, when we look at our files, we have permanent files, current files. Permanent files are things that will relate to various audits. For example, articles of incorporation are not going to change from one audit to the next, yet you would want to have as part of your audit documentation your articles of incorporation. And so what's going to happen, that will probably be in the permanent file. Or if you have long-term type items, that would probably go into your permanent file. Current files are files that are going to pertain to the current year. So your audit program for the current year, the results of your audit procedures for the current year would be in the current files. Okay. Example of, documentation with the lead schedule. And I think I was kind of getting into this a little bit when I showed you how lead schedule might work and then where you can find the various procedures. And all this ties together. Sometimes I'll get I'll have students ask me, well, how does that work? How do I know if I'm using the right work paper numbering sequence? That depends on the entity. Every audit entity has a different way of using their work paper documentation. These days, because so many things are automated, if the GAO, our data collection system, would literally issue a document number every time you entered something into the system. And so that could serve an electronic mark on your documentation, could work as your work paper reference as well. Okay. Tick marks. Okay. And they talk about this tick mark legend down here. Let me put this in slideshow mode. Okay, and they talk about this tick mark legend down here, guys. There is really no standard tick mark legend. Every entity uses different tick marks. So all I can tell you there is that for these tick marks, wherever you end up, or if you're already working, I'm sure you know that you have various tick marks that are unique. Those are unique to your organization. They don't necessarily transfer over to other entities. Okay. Retention requirements, and it depends on whether we're talking about a public company or non-public. I'm going to try to put this in tablet mode and pray that I don't have a disaster on my hands here. Okay, but you could put this into put it in tablet mode, but it depends on if it's a public company or a non-public company. Okay, so if we're talking about non-issuers, document retention is 5 years from the report release date. For a public company, right, issuers, 7 years. Okay. There's also something called the audit completion, and they give you a period of time from the day you release the report to complete all of your documentation. Non-public company, 60 days. PCAOB gives us 45 days. Okay. And the rule there is that you cannot, there's my 45 days. And the rule is that you can't change anything after these audit documentation completion dates. Or I shouldn't say you can't change anything. If you do delete something, you have to write in why you deleted after the audit completion date. Okay, so what was the original document and why you changed it after the audit documentation completion date. Okay, so, you know, unfortunately, these are the kinds of things sometimes that you just have to memorize. Just it's worth noting that the document retention and the completion dates are extended longer, 5 to 7 years, 60 to 45 days, depending on whether you're a public or non-public company. Okay. Let's talk about computer processing. Okay, now these days you have clients that are very going to be highly automated clients. Okay, and so you need to consider that, and you're considering that as part of your audit planning. Very important that you're considering that as part of planning. Okay, and you come over and you take a look, and we have the idea of segregation of duties. And we said in a computerized environment, okay, you could have a combination of the different duties that we talked about separating before: authorization, record keeping, and custody. Why? Because computers don't order, equipment for themselves and take it home. Okay, computers don't, necessarily have a nervous breakdown. Okay, so they process things uniformly. They're not going to be stealing. So you can combine what? You can combine, say, authorization and record keeping in a computerized environment. Okay, now you have the issue also to consider of disappearing audit trail, and that you're not going to be able to look to see that there was the separation of duties like you would be able to in a manual environment. The other thing that happens, I was on audit of the Bureau of Public Debt I talked to you about before, where we audited the federal government's public debt, and they use the Federal Reserve System to auction, issue, service the Treasury securities. Well, when we were first, and remember you're doing this during the planning phase, when we were first planning the audit, we started talking about different documents we would ask for out of the system. And the Federal Reserve Bank said, hang on a minute, you're not going to be able to get these documents from us down the road towards the end of the audit, because we purge our system every 7 days. We're like, well, why do you purge the system every 7 days? And it's because storage costs money. Okay, storage is very expensive, and so entities are not going to sit there saving documents, or saving information on the system so that you can come around and audit it later. So you have to consider that during planning, and you have to work your way around those by either asking them to save off certain transactions or by auditing through the computer in a manner, and we'll talk about looking at some of these here in a second. Okay. The other thing to consider, uniform transaction processing, and that if there is a error in the system, that error is now going to be replicated for every transaction. So if there's an error in the processing, in the computer logic, in the programming logic, it doesn't affect just one transaction, like say a human error, somebody got sleepy and made a mistake. It's every transaction. So the error is amplified across all the various transactions. So you have that consideration as well. Okay, so just some things to think about in an automated environment. Okay, now when we look and we have our computer initiated transactions, is something to be a little bit concerned about, to keep an eye on. For example, if they have a just-in-time inventory system, it'll order goods as soon as inventory levels fall below a certain level, but then you have the concern of, well, maybe it's ordering too much, or maybe it's ordering things that are obsolete, etc. Potential increase for errors. Again, the idea that we talked about, that if there is a problem with the computerized system, okay, being compromised, that can be a problem. Okay, computer disruptions can be a problem. I was on a assignment looking at corporate credit unions. So with corporate credit unions, if I'm a credit union, all of my transactions go through a corporate credit union, which is an automated clearinghouse. Okay, and we were on an engagement where they made the mistake of running both their maintenance and their backup simultaneously. There was a problem, and they corrupted their all of their databases, and their system crashed. And so what happened was, if the central credit union goes down, then all the other credit unions are affected. So people weren't getting their paychecks, and this carried on for about a week or so. And so this is the kind of computer disruption that could cause delays in recording transactions. In the case of this corporate credit union, it was affecting other banks as well, other credit unions as well. And of course, Congress wasn't too happy about that. Okay, the remote access, the opportunity for remote access is also a problem, in that now, if someone, it's not a matter of someone breaking a window and getting into your offices and getting your system. It's what, somebody hacking in from maybe another country, right, and getting into your system. Okay, now those would be all sort of, you know, sad things. Disadvantages. Advantages is the potential for increased supervision, review. Okay, so there can be more analysis that can be done. Okay, may help mitigate additional risk. Okay, etc. Okay, also dependence on general controls. General controls are things like passwords. So you need to be concerned that the entity has the appropriate general controls. Another example of general control is disaster recovery. I was on an engagement where we were looking at how the problem that happened when your client owes money to the IRS. When you send that money in, you don't send that return to Fresno. You send it to San Francisco in many cases, around here anyway. Okay, now what happens is that return gets on a truck at the post office in San Francisco and comes to the city that I'm in right now, Hayward. And that's why I got put on that assignment way back when, because they said, hey, John, you speak Hayward. We want to send you to that particular engagement. So we went, and there they process all of the tax returns in that one environment. And so the one that we were looking at, what was happening was some of the processors, the commercial banks that do that processing for the IRS, for the federal government, they couldn't keep up with their quota, so they were shredding the returns because they couldn't keep up. And Congress is not too happy with returns and checks that were headed to the federal treasury getting shredded. And so they asked GAO to look at that, and I got assigned to look at the one in Hayward, which they were doing a fine job. They weren't shredding anything. But what they told us is that their main system was in Hayward, and then their backup was in San Francisco. And we said, well, you can't do that, because one event, an earthquake, could take out both the main and the backup. So our, sort of accomplishment on that assignment was we got them to move the backup to Texas. So things like that, disaster recovery, are another example of general controls that you'd have to be concerned about in a highly automated environment. Okay, so you have general controls like passwords, disaster recovery, that sort of thing. Okay, now you have your general controls. Okay, and I kind of probably should have had this up before, but security access controls, example, passwords, and then controls over data center network operations, the disaster recovery. You also have though application controls. Application controls are over specific application. For example, payroll. So automated edit checks of input data, right? No paycheck can be put input amount over a certain amount, right? The example in a general ledger software, debits have to equal credits. These are application controls. Now, let me ask you a question. What do you think is more important, application controls or general controls? And the answer to the question is one is more important. Just in case you think it's a trick question. Application. Okay, try again. General. Okay, the general controls are more important. Here's why. If I can hack into a system because it has poor payroll, poor general controls, then I can hack into say the payroll application and change information so that your paycheck comes to me, whatever, right? So it gets deposited directly into my account. So they often say application controls are only as effective as the general controls on which they rely. So even though you would probably test these controls simultaneously, if you came to the conclusion that the general controls were not operating effectively, it would make no sense to really get detailed into application controls. So if you're doing a first-year audit, you're probably going to first check out those general controls, then you'll start to move down to the application controls. Okay, good. General control, application controls, manual controls, where some person, a human being gets involved. That is good for things like large, unusual, non-recurring transactions, Automated controls where you have this system controlling things is probably better for high volume recurring transactions. Okay, computer assisted audit techniques. How do you audit through the computer? You have a very highly automated system. You have this problem of the disappearing audit trail. They're not going to be able to save off every single transaction for you. Are there things that you can do to get yourself comfortable with the IT system that will in place and essentially provide you substantive coverage for something where you're not going to have the documents necessarily to review? So there are 5 computer assisted audit techniques. Then the description of the title they give them, the name they give them, is very descriptive. So it's actually very easy to know the 5 computer assisted audit techniques because the name tells you what's going on. For example, transaction tagging. So use an electronic marker tag for a specific transaction and follow it through the client system to see how it processes. If you can do that, that's a good way to audit the system, audit the transaction as it goes through the client system, even though there may not be a paper trail there. So transaction tagging. Embedded audit module, for example, putting in the client tells you, well, our accounting policy is that if we have an expenditure on something over $500, it needs to be capitalized as opposed to expense. So what would you do? Repairs and maintenance account, put an embedded audit module that will automatically save off any transaction that got hit to the repairs and maintenance more than $500. Now you can take a look at that. Hey, how come? So you're now saving off selected transactions that don't meet certain expectations that the auditor is looking for in that example. Embedded audit modules, and they're waiting for transactions that don't fit certain parameters. Test data. What we do with test data is we go ahead and we take transactions and we do this offline. We process offline certain transactions that the auditor has. So the auditor uses fake transactions, dummy transactions, and we run those dummy transactions through the client system offline, test data. And in that situation, we know how a certain transaction is supposed to process through the client system. And we put dummy transactions through that we know what the outcome is supposed to be, but we run it through the client system offline, like on the weekend or something, to see if it processes correctly. Now, integrated test facility is very similar to test data, but now we do what? Now we do this online. We do it during the week. We do this because we want to see how the client's staff interact with the data and the system. So we have some client staff interface with the system. We want to see how the human beings interact with the system to process. Again, we would commingle now, in this case, live transactions with our dummy transactions at the same time to now see how the client staff interacts with that information. Now, let me ask you, what do you think is going to give you a more reliable assessment of how well the client's automated system is processing data? Test data or integrated test facility?
Integrated.
Yeah, it's more real-time live data, all integrated. So then it begs the question, why would you ever use test data then? Well, sometimes the client may tell you, you're not going to commingle live data with live data. You're going to crash our system. We don't want our operations messed with that way. So if that's the case, then you may go to a test data approach, but now you're going to have to do something, maybe through observation, right, to see how the client's staff actually interact with that system. And so again, you're combining different types of audit evidence to come up to the appropriate conclusion. Parallel simulation does what? Now we take clients' data, okay, and we run it through some sort of software that was written by the auditor, or program that was written by the auditor, to see if the client's data processes the same way through their system as it does through the auditor's written program, to see that we get similar results or the same results. Okay, so all of these things would be used if you have a highly, or any, not all of them, some of them or all of them may be used if you have a highly automated system. Okay, and again, the title is very descriptive: transaction tagging. Tag a transaction, track it to the client system. Embedded audit module is embedded in there, saves off certain transactions. Test data is what? Is the client's, the auditor's data being run through the client system, but offline test, right? It's not integrated like the integrated test facility is, where it's data, the dummy data combined with the live data. Parallel simulation, client system, auditor system, see if you come up with the same answer. All of these are considered computer assisted audit techniques, and there's various software that would use these things. And you know, you could use some of them, you could use all of them. Okay. Okay, good. Oh, goody. Some questions where we're going to get to use the poll on some of these. So let's see if I can set up the poll. Okay, so go ahead and try, let's do question 1 first, and then we'll do question 2. I don't know about you, but I have to move my choices. This is the time when I get to figure out who's not here anymore. Okay. So we've got 6 of 14. There's 8 of 14, 9 of 14, 10 of 14. 11 of 14, 12 of 14. I think that's everybody because I think I'm in here twice. Okay. So the answer here is A. Okay, so half of us got it right. Okay, and I'm not sure if everyone read the question carefully, but let's just go ahead and let's take a look. Which of the following computer-assisted audit techniques allows fictitious and real transaction to be processed together? That's going to be what? Integrated test facility. The keyword there being what? Together, integrated, the what? Fictitious dummy transactions or what? Being integrated with the real transactions, that's integrated test facility. Yeah. Test data would be what? If it was offline, right? Where we weren't commingling the real and the fake transactions. Okay. Okay. Any question on that? Okay. Let's go ahead and let's do. If there's a question, guys, just feel free. Okay. All right, we're in a little bit of trouble with this one. I know we went through some of that stuff pretty quick, but let's just take a look here. Let me put the results up. Okay, so the correct answer here is D. Okay, so we had kind of a split between A and D, but there's also some votes for B and C. So every letter got a chance to hear its name called, so that's good. Okay, but let's take a look. Which of the following computer-assisted audit techniques processes client input data on a controlled program under the auditor's control to test controls in the computer system? So what am I doing? I'm writing a program or a software that is supposed to come up with the same result as the client system. So I take the client data, I run it through a program that the auditor has written, and I see if I do what? If I get the same answers the client system did, now I'm satisfied that the client system is properly processing data. That's parallel simulation. One system under the auditor's control, compared that to what? Transactions, the same transactions running the system of client input data under the client system, parallel simulation. Question? Okay, good. This is the kind of thing sometimes, guys, for something like this, you know, you probably want to look at those slides that we were looking at a minute ago. Let's see if I can get rid of this. Okay. It's not going to let me advance my slides. I go back. Good thing we're okay. This is one of those things that sometimes it might be worth it just to sit there and just kind of make yourself up a couple flashcards on this kind of stuff. I mean, nobody wakes up in the morning and says, "Hey, have you heard about transaction tagging? How about embedded audit module?" You know, so, but it is something you should be aware of this terminology. Okay, good. All right. I guess that's the end. Okay, so that gives us a good foundation, I think. I think we made good progress today, so good work. We'll pick up with the next couple chapters on audit sampling, I think are coming next. So I will see you next week for those. In the meantime, I highly recommend that you are looking at the quiz and the homework now for chapter 6, chapter 5. Those are both in there and on McGraw-Hill Connect, so you want to take a look at those. I'll be posting up the recording for this. I'm sort of handling that now, so it should be up there in the next day or two. Again, I recommend that you look at that on an exception basis, like that last step we just looked at. What is integrated test facility again? You can, rewatch the part of the lecture if you have any questions on that. Any questions before we go, guys?
No.
Okay, well, good work. We'll see you next week. Have a good evening.
Thank you.
Thank you.
Thank you.
Bye-bye.